next guest. We have from Natural Grocers by Vitamin College, CFO Richard Halle. Richard, thanks so much for joining us today.
Well, thanks, Aaron. I appreciate it. I appreciate the invite and happy to be here with you.
Absolutely. We're looking forward to it as well. So I'd love to kick things off for the audience, for some who might be new to the story. Why don't you give an introduction to the Natural Grocers, the story, and what brings you here today to talk about the stock?
Yeah, okay, that's great. Yeah, I mean, Natural Grocers is an expanding specialty retailer in the natural and organic grocery space. The company was founded in 1955. It's still family controlled but public, trading on the New York Stock Exchange. Has 169 stores in 21 states, all west of the Mississippi and excluding California. TTM revenue of about $1.3 billion and TTM adjusted EBITDA of about $96 million. Again, it's a family-founded company. Culture is really critical, and the culture of the company is based on its founding principles, and it starts with nutrition education. The company provides extensive free science-based nutrition education programs to help customers make informed health and nutrition choices. Every store has a nutritional health coach that provides one-on-one health coaching sessions and personalized shopping experiences for our customers. And we also hold in-store events for the community. We also provide our crew with nutrition education to drive a better customer experience. So nutrition, very critical to what we do. That's followed by our product standards. We believe we have the highest product standards in the industry. We have very strict quality guidelines. Our produce offering is 100% organic. Our minimum egg standard is free range. Our dairy department standards require pasture-raised, non-confinement dairy products. Our meat standards prioritize humanely raised and sustainably sourced offerings. We do not allow artificial flavors, sweeteners, synthetic colors, other products. Anything that we believe that could be potentially harmful to human health. And if you go to our website, you'll see a document that's called Things We Won't Carry. And then we offer our high-quality products at always affordable pricing. I mean, we believe that we're the value offering in natural and organic. We do a lot of pricing studies. We tend to be lower than our competition for light baskets. We also believe in supporting our communities and our crew. We have about 4,000 employees. We're very focused on the engagement, development, retention, and well-being of our crew members. We're very committed to promoting from within the company for store management. Crew members are carefully trained to present nutrition information to customers. And we've got a very deep bench at the company. I mean, a very experienced, outside of the executive group, a very experienced management team made up of, VPs that have been here with significant tenure, directors with significant tenure. A lot of people are here and believe in the mission. And with respect to our communities, in 2024, we made more than $4 million of product donations to food banks, made almost $1 million in monetary donations to various causes. We definitely believe that grocery stores play a pivotal role in the food chain, and our products have a purpose to support the health and well-being of our communities. I'd say that some of our differentiation, is around, we have a very sort of unique store format. We have a small store format. It's a shopper-friendly environment. Our store format's about 10,500 square feet of selling space. And, really very friendly, clean, convenient retail environment to shop in. Also allows us to have really close contact with the customer base providing great customer service. And also it really allows us a lot of flexibility in the types of communities that we can go into. So, we are successful across all market types. We're in urban markets, we're in suburban markets, we're in rural markets. We tend to do very well in smaller communities. And our format allows us to go and extend our reach into the smaller communities and be profitable. So I'll stop here. That's kind of just a general overview and happy to take any questions from you, Aaron.
No, appreciate that. That was a very helpful, detailed overview of the story. Um, you mentioned community a lot, so kind of let's start there. Uh, Talk about, so a lot of people on the call here are probably a lot on the coastal urban cities, so we haven't had the pleasure of maybe seeing a natural grocer. So talk about that community aspect. What's unique about maybe some of the communities you're in versus maybe some of the specialty organic retailers that come to mind for people on the call. Talk to us about what might be different about those communities. You mentioned they're pretty broad in terms of rural, suburban, or urban even, but it also sounds like it's a little bit different than what we might think of. So give us a little bit more detail in terms of those core communities that you look for.
Yeah, I mean, we are in all community types, but I would say we tend to lean a little bit more rural and rural plus. So we operate in urban markets. We're in Denver, we're in Dallas, we're in Austin, but we all also in suburban markets around those communities. And then we extend our reach because of our small store format into what we call rural plus communities. And that would look very much like some of the new communities we've opened into recently. Like this year, we opened in Brownsville, Texas. We also opened in Waco, Texas. We are planning to expand our footprint into an adjacent state early next year. We're going to go into Lake Geneva. Those are, in Colorado, for example, we opened in Loveland, Colorado. We opened in Gunnison, Colorado. It gives you a sense for the type of community in terms of size. We tend to do well also with, kind of health-oriented outdoor communities. Those types of communities allow us to go actually pretty small. We'll go into mountain communities in Colorado and do very well in those communities because of, a focus on health and outdoors. But those smaller communities also allow us to be, it's a little easier for us to establish our brand in terms of, getting the word out. And we tend to face a little bit less competition. There are less choices. We know there are a lot of great communities on the east that we'd love to be in. Obviously, that's going to take some time for us, but we're starting to move eastward. We're looking at adjacent states, and we obviously have a distribution relationship with UNFI that has a national footprint that gives us a lot of flexibility in terms of where we can open stores.
That was helpful cover there. Um, so one thing that you brought up was natural grocers highlighting it, not only its organic products, but also at affordable prices. So how are you able to offer consumers the affordable prices while still generating a healthy profit and providing the organic produce and other products?
Yeah, I mean, I think part of that comes from the small store format. It really allows us to be very efficient, right? We don't operate delis. We don't have meat counters, fish counters. We don't do prepared foods. We'll partner and provide prepared packaged foods in our stores, but we don't do any prepared foods. Those are difficult. Uh, they're difficult activities to be profitable in. And given our small store format, it's not, it's something that we've decided not to do, and it allows us again to be one in smaller communities, but two, it gives us more flexibility from a pricing perspective. So, we just have a really efficient formula, and that efficient formula really allows us to bring products at a very competitive price and still be able to drive some leverage to the bottom line.
No, that's helpful. So if we think about the stores, who are you seeing as maybe your primary competition? Who are you looking to source share from? It sounds like it could be, a number of different people. So as you're entering a new community, where has that shopper historically been going to where you might be starting to garner some share from?
Yeah, I mean, we certainly have been. I mean, you look at the stats, you look at what's happening with the conventional grocers. It's clear that we're taking share away from them. You're seeing a very strong wellness trend, towards healthy eating, healthy living. I think people realize that they need to, take control of their health, and the way to do that is through a strong foundation of good, healthy nutrition and supplementation. And that allows us, we're obviously a very authentic player, and we're well positioned to take advantage of that. But I think that we obviously face strong competition from folks like Sprouts. And we believe that we're more authentic. We have higher product standards. And of course, we're, a much more value-oriented offering. When you think about our product standards, again, I would point you to our website of the things we won't carry. We have, we've gained the trust of our customers that they walk in and they know that what they pick up off the shelves, it's not going to have any potential products that's not healthy for you. And so, that allows us to provide a highly differentiated offering from the customer, and allows us to be, I think, very competitive, to have a strong presence in the markets that we operate in.
It's helpful. You touched on it a bit, so I want to make sure we kind of drill down. Anything else that you'd point to in terms of that kind of special sauce that provides you with a competitive advantage, touching on kind of product selection, which you just mentioned, and also the supply chain, which you alluded to as well. So again, maybe if you can just provide, further color on that in terms of, how that helps to give you that competitive advantage.
Yeah, I mean, it starts, of course, with nutrition education, right? So you can walk into our stores, you can set up a one-on-one with a nutritional health coach. We have a nutritional health coach in every store. And so, if you're looking to adopt maybe new type of you're interested in becoming gluten-free, for example, how do you find the things that can help you on your journey to this new diet? So that, nutrition education is a very foundational value for us. And then our product selection, right? Really high quality product selection. And also, we do look at new products, new products that may be trending. We see it on social media, right? A lot of times there's new trends, whether protein-based products. Now, we turned over our SKU count with new products last year about 15%. For us, it has to meet our product standards, right? So that's the critical part, right? We're not going to chase fads. We're not going to chase products that don't meet our product standards. And when you look at our comps, and we've been really pleased with the strength of our comps and the depth of our comps. We're seeing really strong growth in our most differentiated offering, right? And that would be meat, dairy, and produce. Right. Talked about our produce 100% organic. That's where we're seeing the highest comps across categories, and that's our most differentiated offering. And then I would say that, again, the small store format, easy to shop in, allows us close contact with the customer, right? Only 10,500 square feet, and it really allows us to provide great customer service. And I'd say that's another strong differentiator. And then we have, a loyalty program called Empower. And about 82% of our sales last quarter came through our Empower loyalty program. It's been in place since 2015. We've learned a tremendous amount over the years with that program. That program allows us to stay in touch with our customer base. It allows us to personalize the offerings to our customer base. And that's what has enabled us to, I think, have very effective promotions, and it's been a component of why our margins have grown this year. It's been part of the leverage that we've seen is this is our loyalty program and the ability to be very effective and targeted with our customer base.
Thanks, that's helpful. And just quick reminder to the audience, feel free to type in any questions that you have for Richard. We will have some Q&A time at the end of the session. Um, Diving into some of your proprietary products, you have your Natural Grocers brand products. I believe it's nearly 9% of sales today, over 800 SKUs. Can you talk about some of your branded products, some of the margin benefits you get from private label versus third-party brands and where that stands for the company?
Yeah, I mean, we have a, like you said, we have 800 plus SKUs, lots of options throughout the store, kind of covering all categories, product categories. We also do bulk where we package nuts, dried fruit, spices. That is a big part of our private label offering. Um, we are very focused again at high product standards and offering that at an affordable price. Today, it is predominantly margin neutral to the company.
Mhm.
We're very focused on increasing adoption. Because of our product standards, trying to find the vendors that can meet our standards can create more challenges than others, and they tend to be vendors that are on the smaller side. We expect that over time, as adoption increases, we'll see some benefits through volume in terms of driving costs down and improving margins. But today, that's margin neutral for the company.
Okay, no, appreciate that. Same store sales have been strong for you guys, over 8%, store comps through the 9 months of the fiscal year that ends September. That's accelerating from 7% prior year. So, what have been some of the key drivers that have helped you with that strong same store sales, and maybe provide some color in terms of traffic and ticket and how that's differed?
Yeah, sure. Yeah, I mean, through Q3 year to date, sales comps 8.4%, traffic 5.4%. Q3 was the 10th consecutive quarter with positive traffic comp. Basket year to date 2.9%. Q3 was the sixth consecutive quarter with increases in items per basket, and we've had modest inflation. Um, we are seeing really strong comps across the entire portfolio. We over the last few years, as we slowed unit growth down,
Hmm.
we turned our attention to store productivity and really allowed us to fine-tune and enhance productivity across the portfolio. And so in Q2, we stated that mature stores that are 5 years and older, had an 8.5% comp compared to the company comp of 8.9%. I think very few grocers would have, similar broad-based growth. Other, I'd say, key drivers of our growth, obviously, consumer preferences are changing, right? If you talk to a lot of analysts and investors, and a lot of folks are, believe that it's a structural change in the consumer habits towards healthy living, healthy eating. And I think that trend is, I think very enduring. Obviously, a lot of attention to health in the media. And I think, again, we're very well positioned to take advantage of that. And certainly that's what we've seen. We've seen good growth, as we said about, in traffic count, but we're seeing good growth overall in the customer base. Our Empower program, which I just talked about, very effective tool to really drive engagement. And then I think, continuous focus on store productivity has also been a big driver. and our natural grocers private label also another differentiating factor. So I think a lot of things have come to play here, and we've been really happy with the company's performance.
Indeed. You touched on it a bit, but how should we think about the store economics, that four-wall EBITDA? Can you provide, any color on new store economics or cash-on-cash returns that you're seeing?
Yeah, and we published our store economics on our website in our investor presentation at the end of the quarter. The way, average investment in the store is around $3.6 million. That includes CapEx, inventory, pre-opening expenses. We tend to see year one sales at around 5 million, and then experience lower double-digit comps through year five,
Hmm.
and then typically see maturity at around year six. Four-wall EBITDA margins in the 10.5%, 11% by year five, and seeing 25 to 30% cash-on-cash returns by the end of year five. And a lot of that has been based on more recent vintages. Obviously, over the last few years, as we've seen, through COVID, through COVID and post-COVID, saw a fair amount of inflation in construction costs. And so, we wanted to make sure that we captured the right cost structure. But we've been really very happy and have a lot of confidence based on the performance of recent vintages on these metrics.
No, fantastic. Yeah, great metrics there. And let's dive into that in terms of that confidence. So 169 stores today, 21 states. Current fiscal year, planning to open two more stores, but you announced next fiscal year you're going to accelerate that 6 to 8. So what gave you the confidence to accelerate, that store growth? I think you just alluded to some of it, because you had slowed down the store unit growth the past couple of years. Sounds like you're now in a position to accelerate that. So you talk about some of the things that led to that change.
Yeah, I think that, we did late teens, early 20s, kind of back off on store growth, turned our attention to store productivity, feel really good about where we are. The addressable market is very significant. We've already identified, we've talked about how we have, well, we're looking to do 6 to 8 new stores. We have, 6 leases signed. We have another 4 in negotiations. We have another 75 communities that we vetted and have identified and are now just looking for real estate opportunities. We feel good about our competitive positioning, and we feel good about, our format, and it's a very it's a good formula. And we're now at a point, and we talk to folks like yourselves, we talk to investors, and obviously this has been an area of focus for many investors. Yes, we're doing terrific, on our comps the last couple of years with small unit growth, but we know that, to continue to drive low double-digit revenue growth, some of that's going to have to come from store growth, and we're focused on sort of a 4 to 5% growth rate, and something that's manageable. Again, we're a little bit more prudent. We want to make sure that we can self-fund all of our CapEx activity. And, I think we have a lot of confidence. We get a lot of inflow, a lot of requests for store openings from our customer base. And so we have a lot of confidence that the addressable market's pretty significant. If you were to look at, obviously, Sprouts, right, over 450 stores, we're at 169. Whole Foods, 550. Sprouts has talked about taking their store count to 1,400, across the states. I mean, we have a lot of opportunity to grow here, and I think our plan is just to be very prudent. But we're at a stage where we have a lot of confidence in our ability to execute on this growth plan.
Yeah, and to that point, you mentioned on your last earnings call, you identified, I believe, 75 communities that you you could a natural grocers could fit.
Yeah.
So it speaks to that, Tam. So maybe tell me a bit about that. What went into that analysis? Is that within, existing states? Is that including some of the additional states? Was that all encompassing? So maybe just provide some color in terms of when it went into the analysis where you identified those 75 incremental communities.
Yeah, I mean, we have a real estate selection group, and they're constantly on the road looking at communities. So they'll go into communities, look at the competitive landscape. Um, some communities, it'll be a grocery desert, and the demographics are healthy, and the right sort of population size. We may back away where the competitive pressure is just too high. And sometimes it's not necessarily a Sprouts or Whole Foods. It's going to be, a local co-op, a strong local co-op, because the loyalty factor is pretty high. And so we've looked at communities where we thought it would be a good fit. But once we learned more and saw kind of the co-op landscape, we've made the decision that that's not a good market for us. But again, it's a laborious process, community by community, having boots on the ground and evaluating the market dynamics and whether it's an appropriate market for us.
Great. So as we think about store openings going forward, 6 to 8 next year, but the years ahead, I think you said 4 to 5% unit growth. Are there any bottlenecks we should think about in terms of a limit of an absolute number of stores, you'd be able to open within a year, any potential, human capital that we need to bring on to as you get bigger, bigger. Obviously, a lot of numbers hit that percentage. The number of stores is going to have to continually increase. So any type of bottlenecks to think about there?
Yeah, and I think we talk about 4 to 5%, obviously that's where we are today. Right. And we will continue to evaluate that. And yeah, I could see our store growth continuing to increase modestly. And I think that there are limits to kind of the growth that we will want to execute on. We're going to continue. I think we have probably a little bit more of a conservative bent in terms of our capital allocation. We still are focused on delivering a return of capital to shareholders via the dividend, right? We instituted a dividend in 2019. We've returned $116 million to our shareholders. But in terms of bottlenecks, it's just an investment in various resources. We have a really strong real estate selection group. We have a good construction group, and that possibly would require in the future a little bit more investment. Obviously, you're going to have some step variable functions like regional management that you'd have to improve. We do have a crew that does only opening new stores. And so that's another area where, we would invest. We're not, we're fully staffed there and are in good shape for the next couple of years. But those would be the areas as we grew the footprint and grew the annual store count that would require some attention.
Okay, great. And talking about some of these funding initiatives, funding these CapEx, you've generally done it in a self-funded manner. So can you speak to the strategy that you guys have to fund these growth initiatives, as I believe it's been self-funded over the past couple of years. So is that going to continue going forward, fair to say?
Yeah, yeah, yeah. That continues to be our plan.
Okay, fantastic. So another point, shareholder returns. Given the company's healthy cash flow generation, can you speak to the company's historical approach to shareholder returns? You mentioned, dividends. I believe there's also been some time for some special dividends as well. So how do we think about shareholder returns going forward? And does the potential for elevated CapEx as you accelerate store openings, change any of the approach to shareholder returns?
No, I think that we have a good balanced approach to capital allocation today. And so we are committed to returning value to our stockholders in the form of top line, bottom line growth and appreciation in the stock, and as well as the dividend. I don't see that really changing. We have a small share repurchase plan in place. We've used it opportunistically, but I would say it's not much of a tool for us at this point in terms of driving returns. And part of that is a function of the family ownership and the percentage of float compared to the stock that's in family hands. Yeah, and we'll continue. We have a pretty conservative approach. We'll continue to self-fund unit growth.
Okay, fantastic. All right, we're gonna dive into some Q&A now. If we so we have a couple questions that have come in, and if you guys have any other additional questions, please go ahead and type them in, and we'll be sure to get them addressed. So first, marketing. Where does marketing fall into play? Is it a big need for you? And maybe just talk about the overall marketing strategy that you guys have for natural grocers.
Yeah, I mean, we do a fair amount of brand advertising, and that can come in the form of billboards, can come form. We do a little bit of TV advertising. It's fairly limited. We have a hotline magazine that we publish and mail out with a lot of our offerings, and then I would say a lot of our our marketing comes from our Empower program and really focused on driving the existing membership to drive an increase in the basket and an increase in the frequency of shopping, right? So we segment our customers across, frequent shoppers, sort of, and all the way down to kind of part-time shoppers. And we're seeing good growth, sort of movement across our segmented customer base, moving up the chain in terms of larger baskets, enhanced frequency. And obviously, we're also very focused on increasing the numbers of members in our program. Today we have about 82% penetration. We have some stores in the 90s, some stores in the 70s. We're very focused. Every cashier is trained to ask every customer if they're an Empower member. And if not, they're trained to sign them up on the spot.
Mhm.
And so, that's going to continue to be a very big focus for us because we know we're having so much success there.
And does the marketing differ potentially in the larger markets where you might have an existing Sprouts or Whole Foods versus some of your smaller, more rural markets where you're the first kind of organic specialty grocer offering?
Yeah, it differs because it's harder to establish brand recognition in larger markets. And so, yeah, our marketing will look a little bit different. We'll try to do more mass marketing like billboards in larger markets to build that brand awareness. Smaller markets, just a lot easier. That's going to be more focused on community events, reach out events. Our nutritional health coach going out into the community to establish, contact with the community and to drive people into the store. So it's a little bit of a different approach.
Hmm. Okay, fantastic. You talked a lot about the loyalty program. Maybe provide some color in terms of, how do you get your customers signed up? Sounds like you have very high, sales mix, 80%, over 90% for some stores. So talk to us about a bit about the program. How does the rewards work?
Yeah. So, yeah, I mean, you can only take advantage of the discounts that we offer through the Empower program. So we will not offer, for example, our great pricing on eggs to anybody that's not an Empower member. And it's, there's a lot of incentive, to sign up because of that. And then um, uh, we offer $2 back for $200 of spend. And many of our rewards are click to load, right? So the customer needs to be engaged, with the program. We also have a mobile app where you can find unique deals, and we're trying to drive engagement through that as well. Social media is another, important component of what we do as well, and that's a good place to target kind of the younger audience. And, we're seeing the younger audience more and more focused on health. You're seeing a lot of young people, stop, drinking alcohol, for example, right? The focus on health kind of is across the board, but definitely the younger community it's something that certainly when I was that age was not focused on. And social media is a great place to target that audience.
No, appreciate that. That's all for color. As we think about expansion into new states, yeah, how long until we get more to the East Coast? It looks like if you look at the map, it looks like we've been growing at the fingertips, each adjacent state, moving
Yeah.
east. Is that a fair way to think about it? Is there obviously there's some logic to it. So what's the benefit of maybe growing more at the fingertips versus, going out east to maybe some larger markets where you can build the brand equity at least more on a national level. So if you could
Yeah.
talk to us more about the geographic plan there.
Yeah, I mean, we're going to continue to grow in sort of contiguous markets. Um, it makes sense for us to grow. Talked about our partnership with Unified. They have a national footprint, but it's more effective to grow out of existing distribution locations. And so we start there and we look for communities that we don't serve that meet kind of our requirements. And we're going to grow into adjacent states outside of our current footprint. So we talked about Wisconsin, and there are other states that we're looking at that are adjacent to us. And so when we talk about kind of all the communities that we vetted, there's a portion that's within existing states where we're going to continue to build our density. We've opened, Texas and Colorado are our biggest markets. We've recently opened stores in Colorado, opened stores in Texas, and we have many states where we're underpenetrated. So we'll continue to focus on that. And then we've got contiguous states where we see great opportunities. So you're going to see a balanced approach from us within our existing geographic footprint and the geographies that are adjacent to us.
Appreciate that. One more question for me, and again, go ahead and dial anything to into the Q&A if you guys have any more within the audience. As you look at some of the markets where you have Whole Foods or Sprouts, as you guys are getting bigger and bigger, have you started to see any reaction to you guys coming in and offering more affordable prices, similar organic selection? Have you started to see any reaction from those competitors, or are you still not of size enough yet where you really made any type of dent there?
Yeah, I mean, you think about Whole Foods. Whole Foods' mission has changed since their ownership by Amazon. Now they're very focused on being more integrated into the e-commerce machine of Amazon and have sort of moved away from their core mission. They are driving some pricing down as more to attract a wider audience, but now you're finding things in their stores that you wouldn't have historically found. We don't view them as overly competitive. We view them as, some people will use them. Some of our customers will shop there for, let's say, their meat counter, right, delis or prepared foods, and come to us for their other shopping. Sprouts, obviously, is a strong competitor. When they come into markets we are in, we have to, be very prepared. But they're not a value offering. I mean, they're focused on, a lot of, offering a very diverse and new sort of product offering. That's one of their things that they tout quite a bit, but they're not a value player. And I think anybody who does the homework is going to see that we're significantly better priced. I don't see Sprouts moving, you know, down the value chain, I think, from a pricing perspective, right? They're very focused on driving margin improvements in their business.
Okay, fantastic. All right, well, that's all the questions we have today. Richard, I'll go ahead and kick it off to you for any closing remarks before I close things out.
Well, Aaron, thanks for inviting us. We appreciate the opportunity to speak with you and speak with your investor audience. And we're also very happy to host anybody over a call. If there are more questions, you can contact our investor relations group, but we'd be happy to sit down with you and do one-on-ones.
Fantastic. Thank you. Richard Hille, CFO, Natural Grocers by Vitamin Cottage, trade on the New York Stock Exchange, ticker NGVC. Thanks so much for joining. Thanks everyone for tuning in.